When we exit a technical correction, the trend certainly has been continuing to the upside. Are you as optimistic now as those stats may reveal?
Well, I think the action in the market yesterday was certainly encouraging. Stepping back a little bit, after the Fed dealt with very high inflation, they were slow to act, but they've been tightening financial conditions for much of this year. And you can see that, for example, in the strong dollar, in credit spreads, in the yield curve. So all of those tightening of financial conditions led to a decline in equity markets this year as investors feared a slowdown in earnings and profits and a slowdown in the economy. Yesterday's news was a potential game changer in terms of the battle against inflation. So on the margin, it looks like inflation may have peaked, which is a positive for the markets longer term. And on the margin, it looks like Fed policy could potentially change course later this year or more likely in the first half of 2023. And if we get those two things together, lower inflation and a pivot in Fed policy next year, I think both of those would ultimately be positive for equity markets. So I think there are reasons to be more positive looking out over the longer term than there were before yesterday's CPI report.
Yeah, and I guess I was out on Twitter with some hot takes about inflation. It's our RBI later on in the show, and pretty much 90% of the people thought that I was completely 100% incorrect. Well, I didn't just stand up and cheer because 1 month does not a trend make. I mean, if we get 2 or 3 months of cooling data, 5 months, now we've got a clear trend. Only a couple things were down. Most everything else were actually higher. And I just don't understand that the Fed doesn't raise rates by 25 basis points more than it would have, why that matters so much for the equity market, Mike.
Well, that's a key point. So importantly, Fed policy works with a lag. So the Fed's been aggressively raising rates. They started at about 0% this year, and they're already at 2.5%. And the feeling is among investors out there that the Fed will have to tighten policy further, probably a half point in September, then maybe a couple of quarter points or another half point in November, and then a quarter point in December. So ultimately, Fed policy will likely be tighter than normal heading into next year. And we don't quite know what the ultimate impact on the economy will be. Yesterday's CPI report was positive in the sense we haven't had any positive inflation news for quite some time. So the headline number fell from 9.1% down to 8.5%. And the core number actually stayed unchanged at 5.9%. All of the change yesterday was really in commodity prices. And we've seen a broad pullback in commodity prices, whether you look at copper, steel. Gas was over $5 and now is below $4 in many states. We've also seen it in wheat prices, for example. So that's going to certainly help. But things like food and shelter were certainly sticky, as you pointed out. So it's not necessarily an all clear signal yet. And we do need to see several more months of better inflation data before the Fed can signal the all clear.